Welcome to the Power and Market Report. I'm Albert Liu. My guest today is a successful natural resource investor and the CEO of Palisade Capital, an offshore merchant banking group. He's also the host of the Palisade Radio podcast. Collin Kettell joins me via Skype from Guatemala. Welcome to the Power and Market Report, Collin. How are you?
I'm doing well, Albert. Thank you so much for having me on the show.
So it's a real pleasure. I want to start with just a brief background. You're obviously a young guy. I think you hit the ground running on your natural resource investing career. So I thought you might just tell the viewers how it is you got interested in investing in natural resources.
Sure. So I'm 25 years old. Back in 2000, I was fortunate enough to have a father who got into the mining space. He was a professional engineer working at NASA and Boeing and Lockheed Martin before that, and he happened to come across an investment opportunity right at the turn of the millennia there, and he started acquiring assets in Nevada. For some of your listeners that don't know, 2000 kind of marked the bottom of the gold price, a long-term bottom, and from that point forward for about 7 years we had just an epic bull market. And so fast forward a year or two, he would start coming home in 2001, 2002, and saying, hey, I just made $100,000 today, and it wasn't from working as an engineer, it was from his stock portfolio that he was trading at lunchtime. And I became the benefactor of all this great information. I would go on walks every night with my dad, and he'd tell me about options and warrants and private placements, gold equivalent ounces in the ground. And it didn't really click at first, but a few years later, everything kind of clicked into place, and I realized, wow, I know as much information as a lot of people twice my age in the sector. But the thing that really sucked me in is I saw millions of dollars being made, and a lot of it was consequently lost and remade in the cycles that are inherent in the mining sector and the commodity sector. And from that point forward, I was hooked.
Now, prior to that, do you recall your father having an interest in precious metals?
He has always had a small interest in precious metals. Gold has the benefit of safety insurance against paper money, but it was never a huge portion of his portfolio. He held a lot of real estate. Actually, in Spring, Texas, where you're located, he had about 30 properties down in Spring, and so he always liked hard assets. But no, the gold and commodities were new for him.
That's very interesting and very good timing. Some of it luck, but some of it just, I think, having the right idea at the right time. Now, you're obviously predisposed to this, having seen the incredible success, I guess, of your father. You went and started basically an offshore bank. And so I want to ask, why did you decide to take that route rather than other ways of investing in the sector?
Well, I got out of school in 2011, and that had marked about a 3-year period where the gold sector had recovered from that 2008 crash, and a good amount of money was being made again. And I decided that I was going to start to get myself immersed in the sector. So I went up to Toronto and I started working with a merchant banking group that were investing in small junior cap stocks. And I did that for about a year or two. I learned the ropes, and I ran into a guy by the name of Sean Zubik in Toronto. He's now my business partner, just an absolutely brilliant guy. We sat down one day and we said, okay, we have the same idea here. We want to start a merchant bank, and we want to set ourselves up for what's going to be an epic bull market coming in the mining sector. That was 2013. It's now 2016, and the market is far worse than it was. But in hindsight, the timing was very good. We started accumulating quality assets in 2013 through 2015. And at this point, we have a very strong portfolio, mining centric, but also included gas. And just to clarify to your listeners, we don't run a bank, but it's a merchant bank. And what that means is we're investing principal capital, we're investing our own money into the mining space. And alongside of our money, we're offering expertise that we bring to the table sourcing additional financing. We send our geologists and our mine engineers down to mine sites in different countries to help optimize operations. We're basically a full-service group to come in and assist management in places that they're not fully capable or have the time. We not only invest our money, principal capital, into different deals, but we also offer management our time, and that means a mixture of helping to source additional financing, bringing new people into the market, and even sending some of our team members down to optimize mining operations in different parts of the world. So basically filling in the gaps where management doesn't necessarily have the time or capabilities to do everything in-house.
Okay, so a combination of investing and consulting. How about underwriting? Is that a function that you also do?
No, that's not something that we're currently in the business of right now. And the mining space is quite vast. I mean, it's made up of about 2,000 issuers in Canada alone. So there's plenty of issuers for us to go to and kind of offer our bread and butter services to, make investments in, and there's still plenty of quality deals out there that we're able to get involved in.
Okay, interesting. So I noticed you started the group in, it was either 2011 or 2013, is that correct?
2013, August of 2013.
Yeah, okay. So as far as the mining sector goes, it's been quite a rough ride since then. Perhaps this is someone in the heavens getting back at your family for the luck that your father had on the initial venture. It's been pretty tough. How have you managed through this tough time?
Yeah, it has been tough. You bring up a good point. The decline in the mining stocks really started in 2011. And so we didn't come in until the end of 2013, almost beginning of 2014, which was good because valuations had already been cut on the micro cap and junior stocks by 60 to 80%. So, we were fortunate in that we didn't just go over the top. We also have been pretty selective on the type of investments that we've made, and I can't lie and say that many of them have not gone down, but overall we've managed to grow our portfolio in the 2 years that we've started, and we're about alone in that against many of our peers. So the other thing I'll say, Albert, and you know this, starting a business in a bear market forms a much stronger business than one that's formed in a bull market. We've seen tons of peers of ours or banking groups or lenders that have gone belly up and out of business in the last year in the mining space, and that's because they built their business in a bull market and weren't able to survive the cuts of fat that come in the bear market.
Right. It's pretty consistent across the board. Underwriting standards seem to lax a little bit when things are really going well. I want to ask you about your interests in the sector now. First of all, which commodities do you focus on, or are you focusing on?
In terms of the commodities, we're agnostic, and there's a reason for that. We are a little bit more focused on gold and silver, as well as uranium. When you move into the commodities like copper, zinc, lead, one can make the argument that they are not going to necessarily perform as well as the precious metals will in an inflationary environment. There's a lot of truth to that, but I'm going to share some charts with you in a minute and show you that all of the commodities as a proxy in the mining shares, the exploration shares, have been destroyed almost equally. And when something is discounted by 90 to 95%, we would rather look at the quality deals, find the quality management, than focus specifically on one commodity and cut out all the rest.
Okay, well, that's interesting. So I guess one thought that I would have is that in terms of these industrial metals, you're kind of banking on an economic rebound. I know that the downfall has coincided, but in terms of the recovery, one relies on an economic rebound, and the other one, the precious metals, just basically relies on irresponsible central banking behavior and the market acknowledgement of that, which seems to be more of a sure bet. Do you agree with that, or what are your thoughts?
I do agree with you. I think especially for an individual investor looking for an insurance policy, there's no question that gold and silver is where one should focus. But in an inflationary period, which is what I think that we're going to see coming up, and with all the commodities already having crashed, oil took the longest to crash, but has now crashed maybe the most against a lot of other set of commodities. There's not much downside risk left. And I think that people talking about the world economy slowing down, what they need to realize is that much of that's already happened. Commodities react to things before people see them. So with all of the commodities down so low right now, I think the next move is up. I would agree with you 100% that gold and silver, being where they are today, are the best proxy for somebody worried about a potential deflationary or inflationary environment, or weakness in the global economy continuing.
Okay, so is it fair to say that you are finding actually good places right now to allocate capital in the depressed market?
I am. So I'm going to share some charts with your listeners. I know you're going to put these up on the screen. I have them in front of me right now. The first one that I'm going to show is simply the historical gold price chart. And I'm focusing on gold right now because it's probably what your listeners are most familiar with, and it is what we focus most of our investments on, just happen to be in the gold sector. So the historic gold price shows that in 2000, we had that long bottoming process, and we had just a fantastic 11-year upswing in gold where it went up to about $2,000 an ounce. It's now had about a 45 to 50% retracement, and we're hovering a little bit above $1,000 per ounce. What I'm going to show you next is called the HUI index. And Albert, I don't know if you're familiar with the HUI index, but basically it's the 16 largest U.S. miners or listed companies in the U.S. that mine gold. And it bottomed in 2000, about 30, and it rose from 2000 to 2007 to well over 500. So you had what I believe was about a 17 times return. And as you can see, since 2011 to today, it's been 4.5 years going down, and it's been a truly awful drop down. But the next chart I'm going to show you is going to show you just how bad the HUI has gone down. This is the HUI to gold price ratio. And what you'll see is that despite the fact the HUI was cheaper in 2000 than it is today as an index price, the HUI compared to the underlying commodity, meaning the HUI compared to gold, has never been this cheap in history. And what that tells us is that gold stocks, by this metric, have never been this cheap. There's a tremendous amount of value in the gold stocks right now.
Yeah, Colin, let me interrupt for a second. Doesn't that also tell you that in the prior years, the management of these gold companies have been behaving poorly, or at least irresponsibly?
I would agree with you, but I think one of our guests, and my guest that I have on often, Rick Rule, discusses how management is, let's say, less than competent in the mining sector, and I'd happen to agree with that. The mining sector, because of its cyclical swings, invites a lot of people to the table that are looking to make money. And when you're in a bull market, you end up having situations where G&A gets very high, out of hand. People are selling stories that really don't have anything around them. They can pick up any asset they want and say that there might be gold under the ground, build a market cap off of it, build salary, and that's certainly happened. It was rampant, but I think it's always been rampant in the mining sector, and so it's something that is built in. I wouldn't blame this bear market, as opposed to any of the past bear markets in mining, specifically on management being more out of hand this time than they were in the past. I don't know if you have a different insight into it.
Yeah, well, we're talking about, I guess, two different characteristics, and often they appear both simultaneously. But on the one hand, there is just sort of irresponsible and wasteful spending. I think that's what Rick Rule is referring to. But what about just poor, I guess, poor speculation, in the sense that if the gold price is skyrocketing, but that price is set on the margin, often in the options market, where real gold is not really transacting, it's cash settlement. it's maybe not prudent to go ahead with massive capital investment and dividend increases and whatnot. That's sort of what I'm referring to, because then when you have a retracement in the gold price, you're really stuck.
Yep, I agree, and I think what you're underlying is the fact that there was a 11-year bull market in gold, and human nature truly took hold, and expenditures went up drastically. People were building mines at, expecting the price of gold to never drop below $1,500 or $1,600 again. And I would be lying if I said that I called gold coming down this low at $1,900 an ounce when it was there 4.5 years ago. But I think it will take quite a bit of time for management to make these kind of bad decisions again. It's going to take 3 or 4 years of a bull market before these bad decisions are made again. But I have no question that if gold goes this time to $3,000, $4,000, or $5,000 an ounce, that things might get even more out of hand than they did in 2007 and particularly 2011.
Now, going back to the discussion before, are you suggesting that these gold miners in the Huey Index are underpriced for the present price of gold between 1,000 and 1,100?
Exactly. So the miners seem to be pricing in the fact that gold's actually a lot lower than it is right now, and that is, in my reading, is the market saying that it expects the price of gold to go lower. Certainly, miners that are relying on $1,200 or $1,300 gold are struggling right now. They're going to go out of business if gold stays below 1,100 for an extended period of time. But there are a lot of miners out there that are still operating at $800, $700 all-in cash cost, and they are trading. Some of them we've written about on Palisade Research. They're trading at 2 times price to earnings, tons of cash in the bank. I can point to a few of those, just incredible valuations. So what you have is the sector has dragged everything down, and it's important as an investor to sift through these mining stocks and find the ones that might not make it because their cash costs are too high, and the ones that are in a truly spectacular place right now, the market is just not giving them credit for what they've done.
Collin, when you say an extended period, for some companies an extended period is 13 months based on the amount of cash they have on their books. Is there a lot of that going on?
There is, I think so, and like Rick Rule always says, that a bear market is the author of a bull market. As this continues to go on, you're going to have companies that are running out of options. Nobody's going to finance something that already has $200 million of debt and equity value of less than $100 million. That's happening. Nobody's going to come in and stroke a check to continue operating a mine that needs $1,300 gold. If this continues on for another year, there's going to be a lot more casualties in the sector, no question. That's why I think that this cannot go on that much longer. Continuing back to the charts that I had here, I'm going to show you another one. It's the bear markets of gold, the Barron's Gold Mining Index, which is another index like the HUI. And what we've done here is we've taken the current bear market in the gold mining stocks, which started in 2011, and we've actually taken all of the past bear markets in the BGMI, and we've put them on the same timeline as today. And what we find, Albert, is that this bear market, in terms of duration, how long it's gone on, is the worst that there's ever been. And in terms of how much the prices have dropped, this is also the worst that it's ever been. And so relative to what's happened in the past, and since a bear market is a factor of both time and price decline, I do not think that this bear market can go on much longer.
Yeah, and if you think about the gold market in many ways being the inverse of everything else that's going on in equities and the US dollar, we've had just a crazy multi-year run in stocks which just ended this year, and tremendous strength in the US dollar, I think, as a result of all of this central bank easing around the world, people flooding to the US dollar. I want to get back to your discussion about these gold miners and basically the market pricing in a bear market in gold. What are they pricing in terms of energy? Are they pricing in a sustained period of, say, oil in the mid-30s, or Because that's got to be a big factor as well, right? This stuff is, you're moving stuff around. It's expensive. It needs energy.
Yep, you make a good point there too. So, depending on a mine operation, you're looking at anywhere from 20 to 30% of the day-to-day costs of running the mine are your energy costs. And of course, many mines around the world are run strictly off of diesel fuel. Now, what hasn't really happened yet is that the projects that have feasibility studies or pre-feasibility studies, these projects that have been drilled out, a resource has been built, and they're ready to go into production, those are oftentimes still based on $100 oil prices. And that's simply a factor of how long it takes to put these reports together. So I was in an office in Toronto a couple months ago with one of the larger private equity groups that fund these mines. And we were kind of laughing because they're running their metrics based on $100 and $120 per barrel oil. But they know that there's a lot more margin that is in there because the oil prices dropped so significantly. And that's a very good point you bring up. Another good point is the U.S. dollar index, very strong right now. But what are you having happen with gold? Gold is sticking with the U.S. dollar. The fluctuations each day are 10, 20, 30 bucks. But the U.S. dollar compared to all the other currencies around the world has surged significantly in the last year. So the case for gold, in my opinion, is very strong right now. There's a lot of good things happening. It's just on the surface, if you're looking at your mining portfolio or looking at your holdings of precious metals, it feels bad. Everybody else has been making money the last 5 or 6 years in their down S&P stocks while you're losing money. And while the tide is starting to turn, the S&P is starting to weaken, a bear market might be forming. The commodity stocks have not started improving yet. The gold price hasn't really started improving yet. And so until that tide really changes and starts moving in the other direction, you're going to continue having the sentiment in the sector be extremely low like it is right now.
Right, but it's important to note that a lot of people have not seen those gains in the S&P. Only the people that are holding the index or holding the largest of the large cap stocks will see that. I read this morning that I think almost half of the S&P 500 is actually in a bear market at this point.
Yep, I've heard similar numbers, and very good point. A lot of people are not even invested in the S&P and Dow, but that's what they've been seeing on TV for the last 5 and 6 years, and they probably feel left out. And especially if you're buying mining stocks and buying gold and silver the last few years, you thought you had a very good theory, but you're feeling like something went wrong, you messed up somewhere, and the tide's going to change. And when it does, we should have 4, 5, 6 years of a very strong market in the precious metals.
Let's move on to another area that suffered, I guess, equally, in some cases worse, and that's energy. Crude oil. This is January 12th. It's opened with its worst start ever in recorded history, I believe. We're down close to $30 a barrel, Collin. And I don't know if you saw this news, but BP is going to cut another 4,000 jobs. I mean, here in Houston, it's very obvious that things have changed. Let's see, BP's global upstream workforce will be reduced to 20,000, and the cuts are not restricted to just upstream. The oil industry has cut more than 250,000 jobs in the past 18 months. And the only good news there, Collin, is the next time you make it out to spring, we're going to have no problems getting a dinner reservation. But overall, it's been much worse than people have thought in terms of, I guess, the high yield market, even consumer spending. What are your thoughts on oil for starters? How long are we going to be down in the low 30s or even below?
Well, I certainly didn't expect oil to go down to $30 a barrel. What I had been saying was a couple of years ago, particularly the gold, silver, every commodity I could think of, barring maybe one or two, had gone down significantly, and yet oil had not come down yet. So I was expecting for oil to come off. Never saw it coming down this low, and I'm not as in tune with the oil prices as I am with gold and silver. But I think there's going to be some surprises in store. A lot of the banks I've been looking at, that are tied to energy. So some Texas banks, they've made their credit card loans out to oil workers. They've loaned a bunch of money out to the companies who are doing fracking. The houses that they've sold mortgages for in that area by default are going to the people in the area that have been working under the oil companies. That hasn't really imploded much yet. A lot of the junk bonds tied to the oil have not imploded yet. They've started to get a lot more focus on them, but things haven't gotten as bad, I feel, as they might get. I'm not saying that the oil price is going to drop much more. I don't think it's possible for oil to go too much lower. But then again, who really knows? I saw Kyle Bass giving an interview just a few days ago, and he was saying that the next 6 to 12 months are going to offer the best investments for the energy sector potentially in a lifetime. So he obviously sees something turning around quite quickly. I'm not confident enough to make a similar assertion.
Yeah, I mean, a lot of people have been hurt trying to make similar guesses as to the price of oil. I know that you talk about Texas banks. There's certainly that retail and mortgage lending exposure, but I read that Comerica, which is a Dallas bank that you're probably familiar with, has, I believe, an 8% exposure in their loan book to these companies, to these energy companies. So something to watch there.
Yeah.
Palisade is involved in oil and gas. I don't know if it's exploration or development. Can you tell us what you guys are involved in that field?
Yep. So like any other commodity, we're always interested to find a good story. Canada's market, the TSX Venture Exchange, which by the way has been in a bear market for 4.5 years now, is comprised 70% of mining and oil and gas companies. And so there's quite a bit of overlap between the capital raising that happens for the oil sector as the mining, and some management overlap as well. The extent of Palisade's interest in the oil and gas space is when a strong opportunity comes up, and more so in the exploration stage, exploration and development stage, we're interested in taking a look, potentially helping to finance, maybe making an investment. But in comparison to how much money we're deploying in the mining space right now, oil and gas has really taken a back seat. As things start to turn, we certainly might look more closely at oil and gas. I'm always a contrarian investor, and I'm interested in anything that is cheap, but I also need to fully understand it and feel confident in where I'm putting my money. And like I just shared with you a minute ago, I wouldn't be surprised if oil is at $25 in another 6 or 12 months. So I'm just not ready to really deploy a lot of capital in that space yet.
Okay, running out of time, Collin, so we're going to wrap it up here. But in addition to your consulting services, does Palisade Capital offer any sort of retail services? I know you're not a depository institution, but do you offer any services to retail investors?
No, at this time we don't, Albert. If people want to get more information, I would invite them to listen to palisaderadio.com. It's a show we've been doing for 2.5 years now, and it has a lot of overlap with what you're doing, and that's why it's so exciting when you reached out to me. We're talking to some of the same guests. The focus of the show is on mining. We also have a new arm that we launched called Palisade Research, which can be found at palisade-research.com. And we're putting out weekly charts and mini reports on different companies that we're excited about, different events unfolding in the sector. Beyond that, we're not managing money for retail. If anybody's interested in asking me questions, feel free to reach out to me. My email is collin@palisadecapitalcorp.com. And we do have some exciting things coming in 2016, but unfortunately I can't talk too much about them yet.
Okay, fair enough. It's been a real pleasure having you, Collin. Thanks, and I hope we can do it again sometime soon.
Yep, Albert, the pleasure's all mine. Thanks so much for having me on the show.
My guest has been Collin Kettell, the CEO of Palisade Capital. Please check him out at palisaderadio.com. And don't forget to visit powerandmarket.com for insightful interviews with the world's leading experts in economics, finance, and investing. Till next time, take care.